Good morning and welcome to today's webcast, How to Boost Cash Flow in 2017. Before we begin the presentation, I'm going to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm happy to introduce today's presenters, Star Fischer, Partner, Travis Riley, Senior Manager, and Ray Esquivel, Senior Manager, all part of our Tax Services R&D practice. Star, I will now turn the line over to you to get us started.
Thank you, Emily. Welcome, everyone. Thank you for attending. To give you an idea of what we'll be covering today, first we're going to start with just a background of the credit and what qualifies. We'll then go into some new law that is hopefully beneficial for a lot of new companies, and we'll end with some questions and key takeaways. The areas of new law that we'll be covering in this presentation include the permanent extension of the R&D credit, which is just that. For the last 30 years, it's been expired every 2 years, and it is now permanently enacted. So we can count on it not expiring for at least the short term. We'll also cover payroll tax offsets as well as eligible small business credits. To start out, we'll just cover the basics of credit benefits and eligibility for those of you not as familiar with the credit. The credit spans across multiple industries, and what this slide is primarily to show that there's not necessarily a correlation between revenue and the amount of credit or taxes saved from the R&D credit. It's an expense-based credit. Therefore, it really doesn't matter what your revenues are so much as what are you spending on new product and new process development. In order for a project or activity to qualify, it must meet the 4-part test. The first part of the test is technical uncertainty. There has to be some element of uncertainty regarding the appropriate method, design, capability of a new product or a new process. It could also be improvements to products or processes. The next test is process of experimentation. In order to qualify, the activity must go through a process of experimentation, which could be modeling, simulation, trial and error, whatever method you use to eliminate that uncertainty. The third is technological in nature. The research must rely on the principles of hard sciences, including engineering, computer science, biology, physics. This is really to rule out the softer sciences such as sales, marketing, accounting, administrative, those types of activities. and the R&D project must have a qualified purpose. And what this means is it has to be a new or significantly improved product or process. It can't be a minor adaptation for a particular customer or just a simple change to something that already exists. There's also additional rules that apply to internal use software, which Ray will be covering a little bit later in the presentation. So once you identify which projects may meet the definition of qualified research, the following expenses are included as qualified costs. The first one is wages. So these would be employees that are directly doing the R&D, such as engineers, computer scientists, or other people doing product development, as well as those directly supporting that effort. That could be operations, testing personnel across the company. It could also include direct supervision. So these would be individuals who are directly supervising the R&D effort. Could include conceptual development or maybe directly supervising the product development group. The second one is supplies. These are materials used in the process of R&D. And so that this could include items that are consumed or destroyed, as well as items that make it into the final product if it's considered a pilot model or a prototype, or something where there's still some uncertainty remaining in the product. So the third one is contract research. This would be anything that is contracted out related to the R&D effort. So outside testing, if you're hiring temporary employees, outside engineering or consultants, those would all be included in the credit calculation at 65% of the cost. The last one is rental or leased cost of computers. And this was something that was placed in law a long time ago when there were computer centers where companies would go rent computer time. However, it has increasing relevance in today's world with cloud service providers. Cloud computing costs are considered to qualify in this bucket, so we can also pick up those costs. As you can see here, the R&D credit spans all industries. It's really just dependent on, are you investing in new products or new process development, looking at new technologies, really just looking for ways to better run your manufacturing plant or come up with a new product or deliver a new technology platform. It really can span across all industries, just depending on what the activities are. And Emily, that brings us to our first polling question.
Okay, our first question is, which of the following is not part of the 4-part test? Technical uncertainty, process of experimentation, industry first technology, or qualified purpose? And I'll give everyone a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. And let's take a look at the results.
Thanks, Emily. It looks like the majority got it right. The answer is the third one, industry first technology. So this is a common misconception with the credit is companies will think that they have to develop something that's not already out there, that nobody is doing. And the law is clear that it just has to be new to your company. It has to be something new to you, not necessarily industry first technology. And that brings us to the payroll tax offset, and I will turn it over to Travis to cover this part.
Thank you, Star. So the payroll tax offset is a very exciting and hot topic right now. This new law could be a game changer for many new businesses and startup companies who historically have not really benefited from the R&D credit because they're not paying income tax. So if you're generating losses, you're not taxable. R&D credits would just carry forward until a time when you actually start generating profits. So this new law will allow eligible small businesses, qualified small businesses, to potentially offset or cash out their R&D credits to offset payroll taxes. And we are talking about up to $250,000 in credits each year that could potentially offset payroll taxes. So in order to be a qualified small business that's eligible for these offsets, there's really a set of 3 core requirements that you need to meet. The first requirement says that you cannot have gross receipts prior to 2012. So if you had $1 of revenue prior to 2012, you wouldn't be eligible. The second requirement says that you have to have less than $5 million in gross receipts for the year that you're claiming the credit. So since 2016 is the very first year this credit is in place, your revenues would need to be less than $5 million in 2016. Third, you actually need to have R&D credits that you can cash out. And so in order to have R&D credits, you need to have qualified research activities and qualified research expenses. Also, another key eligibility requirement is that you actually have to have employees that you're paying payroll taxes against. So that's kind of an obvious one I just wanted to mention. So one of the key questions that I'm getting from a lot of people is, when does this actually take effect? So this takes effect right now. The way it works is you'll need to elect and file these credits on your 2016 federal income tax return, and then those credits will carry over and you can apply them against payroll taxes in the following quarter. So in other words, you would need to file your federal income tax return by the end of Q1, which should be March 31st, in order to start receiving the benefit in Q2. So the way this is going to work is there will be some new forms that you need to attach to your federal income tax return. There's going to be some new elections that you have to make, and then one of these forms will carry over and be sent to your payroll provider, where the credits will be reflected on the quarterly Form 941 that they file on your behalf. So who qualifies as having gross receipts for 5 years or less? As I mentioned, if you had even $1 in revenue prior to 2012, then you would not be eligible for a credit in 2016. Also, you could have 0 gross receipts, and that would not impact your eligibility for this at all. So it's okay if you have no gross receipts. The definition of gross receipts has been subject to a lot of questions, and a lot of taxpayers are asking for guidance on what constitutes a gross receipt. We've gotten word from the IRS that there will be no immediate guidance on this topic, but for now, the way the rules read is that if you had even $1 of interest income, dividend income, $1 of gross receipts prior to 2012, then you would not be eligible under the rules as they're currently written. The IRS is open to considering some type of de minimis threshold that would be outlined in further guidance or regulations down the road. The reason this is important is because a lot of startup companies, a lot of tech companies may have been in existence prior to 2012, didn't really have any operating income. Maybe they had money sitting in the bank collecting interest, and even that interest income, $1 of it prior to 2012, would make you ineligible as the rules are currently written. So how does the $5 million in gross receipts threshold apply? As mentioned before, that $5 million mark is something that you would need to come in under in 2016. So if your revenues have fluctuated in the past, but you're under that $5 million mark in 2016, then you would be eligible. Also, if you are a startup company that just started in 2016, you would need to annualize your revenues to reflect a full month and still be under that $5 million threshold. Also, if there's any related entities or if you have owners that own or control multiple entities, that gross receipt threshold would apply to the entire group. The entire group would need to be under the $5 million mark. So this credit is calculated the same way you calculate your regular R&D credits. The only difference is there's some elections that wouldn't necessarily be advantageous when you are calculating your research credit, which actually results in most taxpayers claiming a higher R&D credit amount. And so a good rule of thumb to use here is 10%. In other words, add up all of your eligible R&D costs that Star mentioned before, your wages, supplies, subcontractors, cloud service providers, add all of those costs up, take roughly 10%, and that is the amount of credit that can then reduce payroll tax offsets or payroll taxes. So there's going to be a form, as I mentioned before, that will be attached to your federal return and that will carry over to your payroll provider and be claimed there. And that's where we get into the utilization component of this. So the amount of payroll tax that you can offset is the employer's portion of Social Security tax. That amount is 6.2% of each employee's wages up to the wage base of $127,200. So in other words, if you have highly compensated employees, the maximum amount that can be offset is $7,800 and some change per employee. Now, this doesn't just apply to employees who are doing R&D. It applies to all employees company-wide, so your entire payroll. And some examples we have is that you need roughly over $4 million in payroll to absorb the entire $250,000 in payroll tax offsets. This will require some coordination with your payroll tax provider or your PEO, if you use a PEO. If you are using a PEO, you may want to check with them to make sure they're a certified PEO, and also check with them to see if they have the logistics in place that are going to be necessary for claiming this. And so here's an example that we wanted to highlight that just shows what your benefit would have been under the old rules compared to the new rules. So under the old rules, if you had $2.5 million in R&D expenses, roughly you're looking at a net credit of $162,500, in which if you're a loss company, you wouldn't be able to use any of it. Now, under the new rules, if you're a qualified small business, you have the same amount of qualified research expenses. You have a credit of $250,000 that could then be applied against your payroll taxes that you're paying on your employees. So one thing that we wanted to mention, and the reason we mention this is because there are a lot of loss companies that may be familiar with R&D credits, and maybe it's something that you've claimed on your return every year and just went on a carry forward schedule and got carried forward. Once you start using the credits, they do receive a higher level of scrutiny by the IRS. In fact, there was a press release issued by the IRS just a few days ago that talked about the importance of documenting your credits and making sure that they're properly supported. If the IRS audits you and determines that you do not have proper documentation in place, then they may assess penalties in addition to denying the entire credit. And so what we're seeing on a lot of engagements where the IRS comes in, they will deny the full credit amount and attach penalties of 20%. So documentation is something that everyone's interested in. What does that mean to me? What does that mean to my industry? And there isn't a list that we could just provide you and say, hey, keep these things here and you should be good. It's really going to be dependent upon your particular industry, the processes that you use currently, and some of the things that you currently do might be leveraged for documentation purposes. I would say if you're looking for some hints or tips on different types of documentation that could be valuable, there are some guides online on the IRS's website that would provide a roadmap of how they're going to audit these and the types of activities that they look at. And so I would encourage you to head to the IRS's website and take a look at those documents. So key takeaways for the payroll tax offsets. If you are a qualified small business, you might be able to claim up to $250,000 in credits that would offset your payroll. And you could claim this potentially, if you had the perfect fact pattern, this is something you could claim for up to 5 years. So you're looking at potentially over $1 million in benefit. Second key takeaway, this is something that you will elect on your federal income tax return, but then you'll actually use it on your payroll tax return. So there will be some coordination with your payroll provider that's required. Third, you need to act soon, because in order to get a benefit for your second quarter payroll, you need to file by March 31st. And then fourth, the credits need to be calculated correctly, and they need to have proper documentation and support in place if they're going to be retained upon examination. The true or false question.
All right, our second polling question. Companies with no revenue can benefit from the R&D tax credit. Your options are true or false. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. This is our second question. I'll give you a few more moments. And let's take a look at the results.
That is correct. So everyone was paying attention. If you are pre-revenue, you have no revenues at all, then you could be eligible for the payroll tax offsets. And with that, now we will talk about eligible small business credits.
Thanks, Travis. So one of the other major law changes with the PATH Act was reinstating the eligible small business credit. This was done in 2010 as a 1-year kind of opportunity, and now it is enacted for 2016 forward, as far as we know, permanently. So one of the major limitations of utilizing the credit for companies and individuals was alternative minimum tax. If an individual or corporation was paying alternative minimum tax or close to paying alternative minimum tax, they would not really be able to utilize the credit. They can claim the credit, but they wouldn't actually receive the cash from it. It would carry forward to a future year. So for eligible small businesses, they can now use the credit to offset that alternative minimum credit or tax, which is a very big deal for a lot of our clients. So to be an eligible small business, you have to be not publicly traded, has to be less than $50 million in average gross receipts, excuse me, over the prior 3 years, and this is applied at both the entity level as well as the individual level. And for these companies, the tentative minimum tax is treated as 0, and tentative minimum tax is what is used to calculate the alternative minimum tax. So the effect is that it's offsetting that alternative minimum tax. If the credit is not able to be used in 2016, it will carry forward for up to 20 years. This is different than the standard carryback rules for the credit because with the standard rules, you can carry it back 1 year and then forward 20. For the eligible small business credit, you are not allowed to carry it back, only forward. You can still carry it back, but it cannot offset AMT in a prior year. So you'd really be looking at it as a future benefit. And to provide an example of how this would benefit a taxpayer, and here's just a quick scenario. 2016, an eligible small business company had $48,000 in credit. Regular tax was $30,000. tentative minimum tax, $45,000, and that leaves an alternative minimum tax of $15,000, the difference between that tentative and that regular. So all in, their total tax liability is $45,000. So to calculate what they would be able to use, we would look at the greater of $45,000 over 0 for the tentative minimum tax because they're an eligible small business. And then there's this second limitation that comes into play with the R&D credit, and it's what we call the 25-25 rule, and it's 25% over your tax of $25,000. So in this example, it's $1,250. And really what this is to show, this kind of gets into the minutia a little bit, but what it's to show is you can't really use the credit generally to bring your tax liability down to 0, but you can get pretty close to doing that. So in this case, the credit allowed is $43,750. So with the tax liability of $45,000, they're able to reduce that tax by the $43,750. So a very big impact. And then the excess amount is carried back or forward depending on the opportunity there. And this is just a comparison of the two rules. So under the old rules in that example, if you were not an eligible small business, none of the credit would be allowed, and you would be carrying forward the total $48,000, as well as paying your tax of $45,000 in the current year. Under the new rules, if you are a qualified small business, then you would be able to utilize $43,750 of the credit immediately, and the $4,250 would be carrying forward. Just some key takeaways on the eligible small business. It gets a little bit tax technical, but the bottom line is that profitable businesses are generally subject to AMT and to varying degrees. And if now you're under the $50 million in gross revenues, you can use the credit to offset that alternative minimum tax. And eligible small business is pretty simply defined, less than $50 million in gross receipts for the prior 3 years. And Emily, that brings us to the next polling question.
Yep, this is our third polling question. Another true or false. A company must have under $5 million in gross receipts to qualify for the eligible small business AMT exemption. And for those of you that would like a copy of today's slide deck, you can download them from the widget that says Slide Deck and Handouts on your screen. We will also be sending the slides via email after the webcast. I'll give everyone a few more seconds to make a selection. And let's take a look at the results.
Okay, great. It's actually kind of split on this one. This is a tough question. Because the PATH Act basically enacted the payroll tax credit as well as the AMT offset credit, there's two different revenue thresholds, and it can get confusing between the two. So for the payroll tax credit, the revenue threshold is $5 million, which is pretty small. For it to be an eligible small business to benefit from the AMT offset, the revenue threshold is $50 million, quite a bit higher. But those have been a point of confusion for many of our clients because they are enacted at the same time. The payroll is $5 million, and that's because it's for startups primarily, and the eligible small business credit is for $50 million, so that it benefits more of the mid-market type companies. And now we will turn it over to Ray to talk about internal use software and the new regulations behind that.
Thank you, Star. Okay, so wanted to provide some brief highlights of the new internal use software regulations that were recently finalized by the Treasury back in October of last year. Just as a highlight, as the name implies, this is one of the areas where the regulations actually specifically target a particular industry or type of company and product that is being developed. This is something that goes back to 1986, as you can tell from the slide. Pretty long and complicated history, because if you think about it, the area in which these regs are trying to play is one that is extremely fast moving. The world of software is moving at a super high rate. And so you end up in a situation where you have that fast-moving industry and you have a very slow-moving IRS and Treasury. You put those two together and it doesn't add up to a very good scenario for taxpayers in the sense that your rules and your guidance that you're getting from the Treasury may not be as reflective of what's currently in play in the software world. So just from a background set of from the background side of things, those were some hurdles that were facing these rules to begin with. And so we really started to see those come to fruition pretty quickly, late 80s, early 90s, when there was the questions that were starting to pop up as to, okay, what is qualifying for IUS and what is not. The overall premise being we want to create a higher threshold for software products that are not going to be marketed to outside third parties to prevent taxpayers from maybe taking advantage of this provision a bit too much. So a couple of different sets of regulations that were introduced over the course of time to try and meet those points of need for clarification back in 2001 and 2004. Shortly thereafter, 2004, there was a recognition of need for further clarification, and the service says pretty shortly after 2004, we will be issuing new guidance fairly soon. We've all heard that a number of times, and then lo and behold, we have to wait until January of 2015 to actually see those proposed regs. So those came out in January 2015 and were finalized in October of 2016. So the main function, I think the main highlight as far as these finalized regs are concerned, was the IRS's attempt to clear up some of the muddy waters that they recognized were existent in terms of the IUS regs and giving some guidance on what is actually internal use software that the regulations were trying to capture versus what are the things that are meant to be excluded and therefore not included in your R&D credit claim. So as I mentioned before, they were finalized with a few changes from the proposed regs that came out in January of 2015 and then finalized as of October. So they're effective as of October 4th of 16. So as far as the significant points and definitions that resulted from these regulations, these 4 bullet points you can see on this slide are really the main takeaways that you want to have for these new regs. One, they give the clear definition of what is actually internal use software and correspondingly what is not internal use software. We'll talk about those definitions in a second. They introduce the concept of dual function software. And then lastly, it provides a little bit more guidance on what we call the high threshold of innovation test. That's the technical term for the additional 3-prong test that is added on to your usual 4-part test that Star mentioned at the beginning of the presentation. As far as any usual R&D credit claim will have to pass that 4-part test. For internal use software, you will have an additional 3 prongs that you have to satisfy in order to include an internal use software claim. And so that 3-prong test is the high threshold of innovation test. So as far as the definition of IUS, what the new regs are really targeting are those general administrative functions that facilitate or support the conduct of the taxpayer's trade or business. So that is the main point of emphasis going forward as far as trying to figure out, okay, is the software that I'm coming up with, does it meet the IRS's definition of internal use software? That's where you want to start. And it gives a little bit more clarity as far as what actually constitutes general administrative functions. Those are financial management functions, HR functions, and support services. So as you can tell, it really is back office type things that the taxpayer would typically have, regardless of what industry that they're in. So on the flip side of that coin, we think about, okay, well, what is non-IUS then? The two main points you want to think about there is obviously, like I just said, as far as the general administrative side of things, whether that is the main point of emphasis as far as the function of the software, and then secondly, thinking about whether or not the software is developed to be sold, leased, licensed, or otherwise marketed to some third party. Those are the ones that are not going to be IUS, and if that is actually the case, you would only need to satisfy the four-prong test that we had mentioned before. One point we wanted to mention is as far as the examples around the hosted software, that would also be included in the non-IUS world. The examples that are actually in these regs are fairly helpful in that there are a good number of them, and they give some real-world examples of types of functionality that exist out there right now, and the resulting R&D credit internal use software analysis that would result if those were to be claimed on an R&D credit claim. So I would advise, if there's any questions or any further interest on this, I would point you to these examples, because that's really where the substance lies with these regulations, and the helpful nature of them really shines through within those. As I mentioned before, as far as the actual function of the software, that's going to drive whether something is IUS or not IUS. The service and the Treasury is really trying to focus on that. Not so much the actual, like a specific type of software, so anything like bridging software, connectivity that allows more of a networking function, those are probably going to fall within the non-IUS world as well. But again, the function of the from a general administrative side of things is really what's going to drive the analysis. The concept of the dual function software is one that's very helpful in that it provided taxpayers an answer to a pretty long-standing question. And that question was, what do I do when I'm developing, I intend to develop software that is internally used at the outset, but then over the course of time, I end up in a situation where there's outside third parties that are either somehow accessing that software, manipulating, using it. What happens in that world under the current set of rules? So prior to these new regulations, you were out of luck on both sides of the coin, in that because it's no longer something that is strictly internal, you can't claim it as internal use software, and because it is marketed to some other outside third party, but you're also using it internally, you're not able to claim it on that side of the fence either. So what this dual function software concept tries to do is provide an opportunity for taxpayers that fit that description, that have general administrative type software products that they've developed on their own, but somehow make them available to outside third parties, give them the option to take advantage of the credit still for that product. And so what it does is it gives it puts in place a default rule that any time that there's a dual function software product, it's presumed to be developed primarily for internal use. But to the extent that the taxpayer can identify that third party's subset of the software and the functionality that it's using, as well as the corresponding spend for that subset of software, then the taxpayer can utilize this dual function safe harbor to be able to parse it out. So on the one hand, you're able to say, I know for a fact that there's a 75% component of this software product that I use internally that is 75% strictly for internal use. And so what you would need to do is be able to satisfy the high threshold of innovation test for that 75%. And then the remaining 25% that is third-party facing, you only have to satisfy the 4-part test. So we recognize that there's still a little bit of ambiguity in there as far as how you do that, how you go about establishing that subset. But again, that's where the examples come in, because I think that there's a couple of those that are helpful in that regard. Lastly, just wanted to point out some changes that were made by the new regulations to the high threshold of innovation test. What you have on the left side is what was in place in the old regime. It looks fairly similar in that the tests themselves test the same 3 points, in that you got to have something that's innovative, something that represents some type of significant economic risk to the taxpayer, and lastly must be not commercially available. The changes in the new regs with the innovation part specifically point to whether or not the software results in some reduction in cost or improvement in speed or other measurable improvement that is substantial and economically significant. So you got to be able to point to something that shows that reduction in cost or improvement in speed in connection with your claim for IUS. Otherwise, that might present a problem. The significant economic risk, with that one, the focus should be on the level of uncertainty that is resulting as to whether or not the taxpayer would be able to recover the resources that they're spending on this initiative in a reasonable period of time. So that's really the driving point right there as far as what this prong is going to focus on, asking whether or not, is it certain that this is something that will result in a particular result in, say, a year, 18 months. If you can point to certain factors that show the actual uncertainty that's involved with the development effort, that's going to make for a stronger claim and get you past this significant economic risk hurdle. Last one, not too much change there. It's got to be not commercially available, so nothing off the shelf that is that would be able to be used to satisfy the taxpayer's need without some kind of substantial modification. So no real change there. I think that brings us to the next polling question.
All right, our final polling question. Another true or false, the new regulations expanded the definition of IUS, making more software development activities potentially eligible for the R&D credit. Is this true or false? And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification icon. I'll give everyone a few more moments to make a selection. And let's see what the audience has to say.
And that's correct. So what the regulations are doing, primary driver of these regulations is to try and give some definitional guidance to taxpayers. I think everybody caught on to that as far as the question is concerned, but the recognition of the need for clarity on some real-life examples on how these IUS rules apply to the software world as it exists today. And so the result, as far as the regulations are concerned, was the expanded definition of what comprises internal use software. So with that, I think I'll hand it back off to Star.
Thank you, Ray. Now we just have the key takeaways from this presentation. The first is that companies of all sizes and across industries may be eligible for the R&D credit. If you have activities that are meeting the 4-part test, there's lots of additional opportunities now to actually benefit from the credit. The rules are becoming more expansive and allowing for more taxpayers to benefit, and the PATH Act was a great example of how that trend is going. Qualified small businesses can now offset up to $1.25 million in payroll taxes over 5 years, and this is really enacted just because companies that are doing the most R&D were not able to benefit from the R&D credit. And so this really allows those taxpayers to do that and is a huge benefit for all startup companies. The AMT offset, which was kind of piloted in 2010 for 1 year, is now permanent, which has resulted in, for our clients, millions of dollars in potential tax savings over just this year. So add that up every year, and it's very significant. And the new software regulations, although complex, are intended to help expand on what is not considered alternative use or internal use software. So before, the rules were very difficult to comprehend what was internal use and what wasn't. They were written a long time ago before there was a lot of changes in technology and how the technological world was advancing. And so now there's more guidance on what is and is not internal use, and most of it is very favorable to the taxpayer. And that brings us to questions.
Great. Thank you, Star. We do have some time for Q&A. If you have a question that you'd like to ask our presenters today, please go ahead and enter that in the Q&A box and hit submit. And our first question is, are the new IUS regulations generally seen as taxpayer favorable, taxpayer unfavorable?
As Star mentioned, I think those definitely are taxpayer favorable in that they're giving more definitional guidance on what is meant to be included and what's taken out. And we made reference to the difference between the rate of speed that the tech world moves versus the rate of speed that the Internal Revenue Service and the Treasury moves, very, very different paces. And so the definitions that come out of that provide a lot of very useful guidance from a credit generation standpoint, but then also from the standpoint of giving examples and ideas on how it might apply to your specific business as well.
Thank you, Ray. Our next question is, do the payroll credits get limited if there's a change in ownership?
I'll take that one. So the regular R&D credits, if there is a significant change in ownership, they get limited under Code Section 383. As the rules are currently written with respect to the payroll tax offsets, those same limitations would not apply. But I think to truly answer the question, we would need to consider all the facts and circumstances. What kind of ownership change? We would need to get more facts around that to give you a definitive answer.
Thank you. And next we have, is the R&D credit in Trump's tax plan?
I could take that as well. So there are multiple proposals floating around out there. Trump had his proposals. The House GOP has their A Better Way tax proposal. The R&D credit is in both of those proposals, and we're hoping that any final plan that comes about through tax reform would also retain the R&D credit.
And just to add to that, the Trump administration has indicated they're issuing a new tax plan in the next few weeks, and so we will have a better idea of that in a few weeks, but it does receive bipartisan support, and so we're hoping that the goal it would remain intact in some form. It might have some changes.
Thank you. My payroll provider is waiting on the IRS to finalize the forms and e-filing process before they can start applying this. Any idea when that is going to happen?
Yeah, so everyone is kind of waiting for that to happen. They're waiting for the IRS to finalize the forms. We do believe it is a high priority for them. And so we've talked to a lot of different payroll providers, and each one we talk to is somewhere different in terms of how far along they are in the process of building out the logistics and how this credit's going to be claimed. So we do encourage you to reach out to your specific payroll provider to find out where they are in that process. Some that we talk to are hoping to have a system in place by the end of Q1 here so that you can start claiming the credit in Q2. Others, specifically PEOs, might be a little bit further behind. So you'll want to reach out to them and check.
Great, thanks. The next questions we have is, what about software that we developed internally to schedule our internal machine shop better? No third-party use or sale, but we don't use it for G&A functions, and it improves our manufacturing process and output.
I can take that one.
Yeah,
go ahead, Ray. Wasn't sure if you were on it. Go ahead.
Oh yeah, as far as if I heard it correctly, there are no G&A functions. I'm sorry, read the question again, please.
Sure. What about a software that we developed internally to schedule our internal machine shop better? No third-party use or sale, but we don't use it for G&A functions, and it improves our manufacturing process and output.
So I would think that the high threshold, we were talking about the high threshold of innovation test, and that would be applicable here if it is only being used internally. So we would want to think about whether or not there is a result that comes about as far as having a reduction in cost or improvement in speed as a result of this initiative that is in the development work that's going into it. I'm not sure from the facts whether or not we'll have enough to get across that hurdle, but that would be something that we would want to first consider. And then secondly, whether or not there was what the rules term as a significant economic risk, and whether or not they have that requisite level of uncertainty that down the road the resources that they're putting into the development initiative could be recovered in the form of some kind of desired goal that they're trying to monetize. So that would definitely be one where we would need to get a little bit more clarity on as far as whether or not this would be includable. And then lastly, of course, the not commercially available is always one. If this isn't something that isn't already available off the shelf without substantial modification, which I wouldn't think that this would be, so this one might not present as much of a challenge, but the first two we would definitely need to get a little bit more understanding as to whether or not those two tests could be applied or satisfied.
Great. Thank you, Ray. We have time for a couple more questions. If you pay consultants in China, will this count towards the contract research?
I can take that one. If they're based in China and doing the research in China, then they would be excluded from the credit. Any foreign research is excluded from the credit. If you hire a foreign company and they are sending people to the United States to work here, then for their time spent here, we could include it. So it's based on where the research is being performed.
Thank you, Star. Looks like we have time for one more. If a new machine being developed requires additional machinery attached to it for testing purposes, is the additional testing machinery also considered supplies eligible for R&D credit?
I can take that one. So yeah, again, there might need to be more facts explored here, but if you have an existing piece of equipment and you are adding additional functionality to it or integrating it or testing equipment, then that is looked at, that's the R&D project, and then it's, does it meet the 4-part test? And if it does, and it's really kind of a prototype addition, then those would be supply is eligible for the credit. So we do it a lot with integration. Several pieces of off-the-shelf equipment is purchased, which is not eligible, but then a substantial effort goes into integrating all those pieces of equipment, and some of that can be considered a pilot model and eligible as a supply. It's also considered an R&D effort. So maybe explore more facts, but generally speaking, if it qualifies as R&D, then the supplies would be includable.
Great, thank you, Star. And it looks like that is all that we have time for today. Thank you, Star, Travis, and Ray, for a great presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive that credit. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress icon at the bottom of your screen or to the left of the slide window. Open the icon and click the printer at the bottom of the window to download a PDF copy of your certificate. I'll keep the webcast console open for a few minutes now to give you time to do this. A copy of your CPE certificate will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.